And welcome everybody. And it's a beautiful Thursday afternoon. And tariffs are probably not the most exciting topic to have a conversation about, but commercially they're going to be very important for the next couple of years. So what I wanted to do in the next 30 minutes, really, before we go to questions, is I wanted to walk you through why we're where we are today. Now, I think it's really important to understand what the dynamics behind this and what are happening. I then want to talk about what tariffs actually are. And then finally, I want to conclude with how every individual business has got to look at this situation and make some critical business decisions about how they move forward. Like most events that happen in the business calendar, whether it was Y2K, the introduction of Euro, or even the more recent one, which would be Brexit, these generational events effectively are created because what happens is there's a seismic shift somewhere in some part of the world. And on the back of that, companies have to check their own vulnerabilities to make sure they're fit to survive through this period of time. The good thing about all of these interventions is that they do always finish. And I'll talk a little bit more about that as I go through the materials. So bear with me as I go through a number of slides here, which I hope illustrate and share a deeper understanding as to how we got to where we are right now. So firstly, let's just go to start off this way. I suppose in summary, if I was to paint a picture of the key messages, what I want to talk about this afternoon, is firstly that we should understand that no matter what way you play it, tariffs are taxes that are imposed on imported goods. Now, they're always imposed on imported goods as they enter the market. They have nothing to do with the purchase price of the item when it's in the market, but it's always about as they come in. The second thing about tariffs is that tariffs are either hidden or overt. The current slew of tariffs look very overt, but of course there can be hidden tariffs that we have to consider as well. And that can be a fallback position if overt tariffs in themselves don't work. Now, definitely what happens is they increase the cost of goods entering certain markets, so that either makes them competitive or non-competitive, as the case may be. They have a huge impact on pricing. They do actually, down the line, have a medium impact on supply chains and ultimately are critical to profitability of a business. What countries find out typically, and what companies within countries find out, is that the structural vulnerabilities of their economies or of the company itself starts to get exposed in a tariff situation. And that's what has to be tackled. Now, I won't paint too big a picture on that, but if you look at the actions that China is taking in their standoff position with the US on this, you can see they're trying to tackle some structural vulnerabilities in their economy. So, for example, they're releasing tax rebates for the first time. They're mobilizing their gig economy because they're trying to keep the activity within the economy ticking over. But it's highlighting structural vulnerabilities, particularly in their real estate markets, but also how they actually conduct their market affairs. Canada, on the other hand, and I don't know if you heard Mark Carney's comments on this internally, but he's got to handle a productivity challenge that the Canadians have, which has been masked by the current trade agreements that they've had with the US and the benefit of the US dollar over the Canadian. So really the point I'm making is that no matter what happens to the tariff situation, you are going to find yourself dealing with vulnerabilities within how you're organizing your business to trade internationally anyway. So this is a good opportunity, one way or the other, to get on top of those scenarios. There is a strategic framework that we think you can use, and I'm going to talk about that in more detail. I do think we need a topic on the area of contracts, particularly existing contracts, because there's a number of contracts that I've been asked to review in the past couple of weeks, and there's some challenges there. We also know now that future contracts are going to be changed on the basis of what's happened, and I'll talk briefly about that. And the last takeaway I want you to go away with is the following. There are rules of engagement for how we're dealing with the tariff situation. I want to explain it this way. Tariffs are typically imposed top-down. Business typically works bottom-up, business to business in an international setting. There are rules of engagement that you have to absolutely reinforce if you want to get through this period. And the rules of engagement have got to be, firstly, be very transparent about the tariff impact on pricing, offer detailed explanations for price adjustments so you can get people to a level of understanding. There is an opportunity to provide alternative product options, including the fact that services are currently not going to be tariffed, as we know of. and there's the opportunity to bundle, which offers opportunities to get around these situations. And ultimately, we have to remember this: tariff scenarios invariably always end. So strengthening the relationship you've got with your client base through a consistent form of communication through this period. In other words, use it as a means to constantly engage. Now, let me start off at the top of this very quickly, and I'm going to charge through this without spending too much time on it. But just to let you know, the real thinking here is their taxes, they increase the goods at the point of entry, so to the importer, and they affect pricing chains, supply chains, and profitability. And we know they can come in fairly quickly. We also know they can be lifted fairly quickly. Now, we're in a different game about tariffs right now, and to some extent, this is distracting us from what really needs to be happening in the conversations about tariffs. So while we hear these big numbers being thrown around, we have to remember at this point in time, no real number has been presented on the table, and it may be just a means of getting to a conversation. But either way, the lessons that we're going to learn are ones that we need to continue applying into our businesses to allow them to get through this period. My personal view on this is that there will be an attempt to get to the off-ramp on tariffs. The announcements that have been made, my sense coming out of US states in particular is they'd love to get to the off-ramp on this. But I don't think they're going to be able to get it there in time. So I think we're going to have to live with this level of uncertainty. And the point I want to make here is the great things about tariffs is that we know they do and they have been introduced, but we know they've also been removed after a short period of time. So we know they don't work, but we know they can be used to cause a shock to the system. The trick of a business, frankly, is to survive through that period, because on the other side, there's more fertile ground to harvest. But just remember, whatever you're struggling with and the types of ideas that you might be trying to deal with as we go through the presentation today are structural vulnerabilities that are already inherent in your business, and they're the ones you're going to have to address one way or the other. So let's talk about, I just want to spend 2 minutes on this because people often say what's happening is something very different. I think if I was to look at the Biden administration and look at the Trump administration in the US, just so you understand what's been going on, the motivations behind the policy levers they've been using have not been that different, in fact. So you've got the China trade tensions, the feeling that China has benefited at the expense of the US economy, which is driving a lot of ill feeling at this point in time. You've also got a core challenge around wishing to protect key industries. That's why Biden introduced the CHIPS Act. It's why you have the IRA Act introduced by Biden as well. Whereas on the other hand, they do want to protect some industries, and they're very concerned about that. And I'll talk briefly about how that you can see that. There has been a belief system that reshoring is important to the US economy, particularly around supply chain security, which was exposed during the COVID pandemic. Obviously, there's some geopolitical playing going on, which I'm not going to comment on. There's a key area around energy dependence. Labor and wage protection is a big factor in the US thinking right now. And obviously there's political leverage and domestic appeal, which kind of ties into geopolitical stuff. But you can see where these key factors were coming together. The trifecta of acts that Biden brought through the administration in the United States at the time through Congress, they were trying to build carrots to change some of these dimensions. So they were building incentivization structures for companies to land in the US and engage with the business there and set up more businesses there and effectively employ more people there and increase the GVA in particular states. What we're seeing here with this tariff introduction is exactly the opposite. It's to undo that and effectively the belief system that says you have to shock the system to try and get a response faster. The incentive way will take too long. So it's just worth reflecting on this because it means the following. One way or the other, no matter what happens after this period, there is going to be more effort to try and balance these motivations out. This is not going away and has not gone away for a long time. And why is that? Well, firstly, federal budget, if you go back to 2005 to 2025, is literally out of control. It's running at about 1.9 trillion at this point in time. Obviously, if you took out the COVID wave, that's been a growing deficit that has been growing for some time. You'll all have heard about the debt ceiling in the US. Congress has effectively given away budgetary control to the office of the president. That must be very concerned about the fact that their debt ceiling is now up at 31.4 trillion, and it's unlikely that you can start to see the downgrading element of your credit ratings as an economy into that, and that's why the Fed is not budging on interest rates at the moment in the US. So there are very powerful forces at play here within the American economy that they feel need to be balanced out. And whether you use a carrot or a stick, this is going to have an impact on how we do business with the US. And one last thing I just want to comment on, although Biden did pass the Infrastructure Act, which was a very slow burning act as well, this reads like a report card from my leaving cert. And it's pretty much around infrastructure in the US that is pretty much in the doldrums and having a huge impact on US productivity. And they need to fix that. And to fix that, they need to have money. But to have that money, you've got to do something with the debt ceiling. You'll hear about fentanyl. I just want to highlight this issue. Fentanyl is probably taking out about 100,000 people in the US right now, which is more than pretty much any other war has ever taken out. And then finally, this is a key factor. You'll often hear this being expressed about tariffs are a way of protecting national security. I just picked one element to illustrate that. If you think about the Stinger missiles that the US has donated to the Ukraine since 2002, they cannot restock. They do not have the engineering or the production capability to restock that capability until around 2026. The implication of that is that they feel they're now more vulnerable and that their security level is now at risk. So that's something that is driving the thinking of no matter what American administration comes into play. How can you start to resolve these issues, balance the budget, and start to eat into the deficit so you can spend more money in infrastructure and safeguard jobs and income levels in the United States? The problem with the tariff scenario is that it effectively gives us only three elements that we can engage in from a strategic point of view. The first is you do have to assess the impact. Now, every company is going to have to assess the impact, understanding their value chain in detail. That means you're going to have to look at where your raw materials are coming in from, whether you can substitute some raw materials for US raw materials, for example, which is one of the purposes, of course, but your ability to understand what the impact directly is on your product and the rules of origin of your product are going to become very essential. If the rules of origin of your product are telling you that the predominant amount of your product is coming in from China, that's going to be classified as a Chinese product. That's going to have to give you significant impact on the US environment, no matter what the EU-US trade agreement is. So you've got to really understand where your product's coming from and where the value added in your product is created to get over the rules of origin. The second is you do have to understand very carefully the market segments and products that you're engaging in the US market, because what's most likely to happen, and we've already seen some of this, is some tariffs get walked back or parts of tariffs get walked back. Typically in trade negotiations, there tends to be an undulating structure between individual products and individual market segments. So you've got to be very clear about what market segments you're in. If you're in the medical sphere, for example, there are some categorizations of FDA capability at the moment that won't actually incur tariffs, just the same way as some chips for the iPhones and some chips for other tech capability will currently not incur tariffs. So it's really important to understand what market you're playing to and how you express that market. And finally, you've got to adjust the pricing strategy. If you're at a cost plus strategy at this point in time, you're probably at a high level of risk. You've got to move to a value-based strategy approach, which has got variability built in there, depending on the value you're offering. And you can change the parameters of that value as you go to deal with particular customers. Now, I'll try and unpack these one by one, just to go through these very quickly. When you're looking, though, at understanding the impact, so the first part of this, please understand your cost increases per SKU or your commodity codes and how it impacts you from a regional point of view. You do need to understand what market compression, margin compression you're going to be experiencing by product, and you're going to have to decide what are your high risk and low risk segments. You've got to have that level of granularity to navigate this, because typically you're going to see the grouping of commodity codes for these tariffs in the future, one way or the other, even as negotiations take place, and you have to be ready to deal with that. It's interesting if you observe what the EU's response this morning was to highlighting where they would impose tariffs, and you'll see them actually trying to calculate that out on the basis of high and low risk segments to the European community. What that really is a statement of, we want to negotiate here. They're really trying to get that onto the table. When you look at pricing, I think if you are cost plus, was always going to be a short-term answer. You need to move to a value-based pricing where you can increment a value either by services or by bundling or by tiering other capabilities and certain other tradables that you have within your locker. And that's going to vary by company because it varies by sector, but it's going to be really important to do that. You'll also have the opportunity to launch lower feature and perhaps tariff resistance SKUs over time. And I think that's a really important way to think about market entry, with additions coming on to play in bundling through either service connections or other connections. So it starts to get you to really think about how the product is working. And at the moment, there are Irish companies currently doing this. I'm just finished working with a company at the moment from Ireland that's actually decided to skin back the product to a very core basic element where it can actually have a higher level of US content to get in. And if you want to augment the product thereafter, which the customer can elect to do, it's going to be driven around a services model, which starts to take you out of the tariff gambit. So again, that won't work for everybody, but it's something that you have to really understand within your business. It is really essential, though, that you always communicate value. So if you're seen to be just an item that is triggered at a cost point without any real incremental value delivered to the customer base itself, you're going to end up in a tariff situation where your costs simply increase. You either take a margin hit or you lose the customer. So it's going to be really important for you as businesses to reinforce your product or your service differentiators. Ideally, skin back product, highlight service differentiation, because that won't be covered by tariffs at the moment. Very clear communications on price changes. Don't do the Amazon thing. It's all right to say, we would have charged this. This is what it will be now because of these factors. And please use value storytelling, referrals, and comparisons to allow people to understand the genuine good value you're delivering. At the end of the day, companies still seek value, and they seek value in a number of parameterizations, not simply product, but also service level, the experience, and someone who actually understands what they're trying to achieve. And communicating those clearly start to mitigate the impact even of an increased price through tariff. You're not going to get away, and I think this has been a trend going right back to the Biden situation, where the incentives were offered under the trifecta of laws. So that's the CHIPS Act, the Infrastructure Act, and the Inflation Reduction Act. You are going to have to start thinking about, where am I getting my supply from? Because one of the key aspects of this, as I mentioned, is the dependency on China, where you're going to have to start thinking about, does my supply chain need to work that way? Can I increase the responsiveness of my supply chain if I go more locally sourced in Europe or locally sourced in the US with some components? Even though that may increase the overall cost base initially, it might give me an advantage in terms of responsiveness or the ability to turn on different terms and conditions of supplying products. So again, every business has got to think about this in the context of their product and how their product is working. And that's not in itself a bad thing to be doing anyway, because in some ways we have to recognize that costs in Asia have been increasing. I say Asia even beyond China at this point. And at a certain point in time, the damage to responsiveness and the capability of us to deal with supply chain variations should have been factored in anyway. So this exercise in itself will be a good thing. If you're bringing new products to market, you're going to have to really think about product design for cost efficiency. So that's the other aspect of that. A big thing right now will be to enhance non-price value. So tradables like bundles, warranties, services, loyalty programs won't be tariffed, flexible financing won't be tariffed. These are tradable areas, improved customer service or customer speed. This is where you can enhance the non-price value of your business to still make it more attractive to deal with you. And I think it's a strong point I would make, is that you got to keep your eye on this and see, because this isn't going to have a huge cost impact to your business, but it will give you a strong negotiating position to clients when they understand that transparently you're reaching out towards them to try and make sure the value equation stays the same for them. What you're going to have to do also through this period is you're going to have to track what the competitor responses are, because already we're seeing across different sectors very interesting competitor responses to what they perceive to be, whether it's early shipping, late shipping, stripping back of product or whatever. It's a good idea just to keep an eye on that. It's important to use this opportunity to always check on customer sensitivity. And it will be essential that you watch your price point constantly. So this is not going to be a cost plus environment anymore. This is going to be a value-based environment where you're pricing based on value, but you're looking at real-time market data all the time to understand if you're in the right place. This is not a balance sheet effort where you simply publish one and then hope that nothing happens. You've got to step away and have almost a constant activity monitoring this in the background and iterating it. So lots of stuff out there, of course, in every situation. I really didn't want to put this slide in because I'm not a huge technology fan unless it's actually doing something for a business. But you have the opportunity to leverage technology and data here. There are price optimization tools that will help you out if you wish. You can implement some new AI and analytics tool sets. Please don't just swallow the whole AI noise factor. Use it to help you navigate through this period. And please use real-time information and data if you can, because that will tell you a lot more about what your customer base is trying to do. Now, I'm going to keep going at this pace because I think it's a Thursday afternoon and we're happy to take questions anyway later on, but let's keep going at this rate. I'm suggesting that all of you spend a week or two on what I've just discussed, applying it to your business and come up with an action plan that has 3 to 5 immediate steps for you to deploy. Now, this may seem like a lot of overhead to your businesses, and I really do respect the fact that we're all pretty much pinned to our collar at the moment in terms of time availability. But at the end of the day, if you're dealing with the US market, these issues have to be tackled. So you're going to have to develop 3 to 5 immediate steps to get you through this initial period of uncertainty. You will have to develop a long-term resilience strategy, and the important thing will be to measure and to be as responsive as you can be in terms of how you're reacting to what's going to happen over the next 18 months. The tariff situation may get abated. There will be some element and some attempt to get to an off-ramp, but fundamentally, the scenario of having to be challenged on these fronts, even in negotiations, will take a long period of time, and you'll be vulnerable to change in that period of time as well. So this doesn't get to go away. But as I said earlier on, by following through on these actions anyway, your business will be in a stronger place irrespective of what the outcome is. And it will benefit all of the business, not just simply the international part. Let me just run through another few parts if I can on this. Okay, just on pricing and contracts, because I get asked that a lot. So on pricing, I've said this before, during tariffs, you're going to have to adjust. You're going to have to implement dynamic pricing models, value-based with a high degree of flexibility. Try to strip back the product if you can, introduce more bundling, more service updates if you can, and position the product in that way. I would suggest you start to use tiered pricing for different regions. You see the Swiss government pushing this very aggressively at the moment, and consider absorbing part of the tariff to remain competitive. This won't go on forever. So if you need to get sticky, you might need to get sticky and make a margin hit on this. But at all times, please keep looking for working and partnership to reduce production and logistics costs, if at all possible. On contracts, because this is a very tricky area for us, particularly if there are existing contracts. So I believe we're going to see contracts change from here on out. There will be, in the future, there will actually be tariff clauses. There are actually already contracts with tariff clauses in them, but not many of them. But I noticed that the legal profession is now publishing white papers about what a tariff clause within a contract should be. So you can expect to see that in the future. If you're struggling with having a conversation about the impact of tariffs, it is not impossible to use force majeure clauses to cover the unexpected tariff increases, because no one could have seen this coming. Now, it's not a great idea when you're reaching for the force majeure clause, but if it's needed to start a conversation and you're literally in a loss-making situation, it's better to start the conversation. You're going to have to be very careful in the future about defining the nature of tariffs, so if they're overt or hidden, and who has the responsibility for those costs, because that's something that you can manage and trade within a contract situation as well. Please look at Incoterms. Anybody who knows me or sat and talks about this before, I'll always say Incoterms, typically we gloss over them, but they're the most fundamental part of understanding what you've actually signed up to commit to. And believe it or not, the cost base in the current tariff environment starts to ramp up seriously depending on the Incoterms you're using. So please have a look at those as well. And finally, we're going to need more break clauses in contracts. So there's going to have to be regular reviews and renegotiation based on tariff changes. Let me come to that point one last time. I'm doing a sentiment poll at the moment with a number of large US companies, well, mid-sized to large US companies. One thing that's coming back to them is they recognize that prices are going to be increased. What they don't like, and I think it's worth you being proactive about this, is a world where they're always hit on when prices are going up. But if prices go back down, they tend not to see the benefit of those. So if you're going to have an opportunity and put in a regular review clause, please do so, but also make it clear that will happen when prices go down. Because if tariffs are reduced from one level to another, that's a benefit to that business as well. And you should share, that should be shared openly and transparently with them. That form of belief pricing is a really key way for companies to endure and build a loyal relationship with you. So you're not going to get out of this without having to do a few things that possibly the business should have considered before. One is to diversify suppliers across different regions, which you're starting to see emergent now in the landscape. So people are picking up that if I'm shipping to this market, I'm going to buy the product from there. And if I'm shipping from this market, I'm going to buy the product there. I'll give you an illustration of that. Just one US company has decided they're going to buy buckles for these elaborate belts they make. They're going to buy them from the EU for product they ship into the EU. And that will change the parameters of how that product is perceived as it goes into that market. You might have to look at some degree of last minute configuration or production in countries with other agreements. You might have to consider the ability to stockpile inventory, collaborate with logistics partners to optimize routes, but you're always going to have to monitor trade policies and stay informed. The problem with talking to such a large disparate audience is that this will vary by sector and by individual company structure. So you've got to have a close look at these, but I want to conclude with two other points around this. Firstly, communication with customers will be fundamental to getting through this. Transparency about the pricing structure and the tariff impact on pricing. Detailed explanations will be essential. Providing alternative product options or bundles, but strengthen the relationship through constant communication. Use this as an opportunity to spend more time talking to customers. One last thing, in the packs, which I guess Jonathan will probably allow companies get if they want, so this presentation, I've broken down by sector where I think the major changes in the individual sectors will come about. Now, I'm not going to go through that now, because if you're not in a sector, then it's going to be boring to hear me talk about automotive, aerospace, chemicals, or pharmaceuticals, etc. But have a read and understand where we think the key impacts are coming, and then try and distill how that comes down to you. One last point I want to make on all of this is that it can appear to be a bewildering cacophony of noise right now about tariffs, and it can appear to be an absolute headache. But let me share this thought with you. For every individual business, you do not have to digest the entire tariff playbook. You only have to digest the part that plays to you and your customers. And although people think that's an onerous task, the truth is, to get through this exercise is an exercise in work content and not elapsed time. If you do enough focus effort at this, you can pretty much answer most of the steps I've brought you through this afternoon in about 3 to 5 working days. And whilst that may seem like an awful lot, it's not as much as losing the market in the United States for perpetuity. Those who make it through this period will find that there are sunny upslopes on the other side, because the one thing we know about tariffs is they always do end. So, Jonathan, I think I'll give it back to you there.
Great. Thanks a million, Colm. It's a lot to take in and fantastic delivery. So thank you very much. So listen, I just want to finish off now by number one, thanking Colm for the webinar and for the work that he put into preparing it and for the delivery. We really appreciate it, Colm. Secondly, I'd like to appreciate and show my thanks to everybody who participated this afternoon. This is the first one of a number of webinars that we're doing. The next one will be with my colleague, Katie Kent, and she'll be joined on the 21st of May with another international expert called Sam Lowe, and they will be looking at specifically at US-EU trade rules and what you need to consider in terms of market entry, impact on your sales, and impact on your supply chain. So that's on the 21st of May, and we'll send out details to everybody about that. But you can get all our information about our webinars and about all the consultancy services that are there, including Colm's details, if you go on to our webpage, enterprise-ireland.com, supports trade tariffs. I've also put up there our email address. So if you have any specific queries, please send either myself an email or send it through to exporttariffs@enterprise-ireland.com. And we have a team who will direct you to the right answers if we can answer them. And if we have to bring in Colm or another expert, we will absolutely do that as well. We've got some nice information up there. We have a range of Enterprise Ireland supports for you as our clients. They range from a introductory consultancy support, an 80% grant that will allow you to take some of these issues and work with Colm or some of his colleagues in a more specific area. It could be around supply chain, managing your finances, tariffs, customs, rules of origin, the whole gambit of these trade issues that we're looking at. We've also got a larger consultancy support that can help you take those conversations even further and build them into strategies. And of course, you'll all be aware we have a whole array of supports around helping you build your market presence and do market research to look to diversify your markets as well. Ultimately, our message for clients is very simple. You need to be more efficient, you need to be more innovative, and you certainly need to be more competitive and have a really strong value proposition whenever we're looking through these times of uncertainty. So I'm going to leave it there. We'll send everybody the links, and thank you very much for your time, and thank you, Colm. Good afternoon, everybody.
Enjoy the evening. Thank you.